Inflation, that's the topic of conversation these days, and everybody wants to know, how is inflation impacting mortgage rates?
I belong to you.
Good afternoon, Chad Helmcamp here with BWC Lending. Well, mortgage rates tend to be a lagging indicator, meaning inflation goes up first, mortgage rates go up second. And primarily that's because when inflation starts to really climb like it has over the last year or two, mortgage rates didn't go up right away. But once people realized that inflation was here to stay, the Fed realized they needed to step in and do something to try to get inflation under control. So they started raising short-term rates, which is the Fed funds rate. Well, as they raise short-term rates, long-term rates start to go up. And the long-term rates usually go up faster and before the Fed does what they do. So that's why anytime you hear the Fed saying they're going to raise the overnight rate, more often than not, that's already priced into mortgage rates before they've even done anything. And so right now we're expecting the Fed to raise rates several more times this year at a pretty aggressive clip. And meanwhile, mortgage rates are at the highest level we've seen since 2009. So they're very high compared to where they've been. Our expectation is they're going to stay at an elevated level for at least another, 12 to 18 months potentially. We're just going to need to watch it and see. But once you start to see inflation come down, in all likelihood, shortly thereafter, we're going to see mortgage rates come down as well. So that's what we need to be paying attention to. This week we had inflation numbers come out a little bit hotter than anticipated. So we saw mortgage rates spike back up again. Hopefully, as we start to see those inflation numbers ease, we'll see those rates come down and the whole market will benefit. Thanks for watching. Hit subscribe below. We'll see you next time.
I belong to you.
I belong to you.